In this knowledge-based video, we're going to go over the income underwriting advisories and their role in qualifying a borrower's income. Now, an income analysis system has more than just math to qualify a borrower's income for the agency guidelines. First, we have to calculate to determine a qualified income for each period. For example, in a Schedule C, we'll take line 31 and make cash flow adjustments such as line 30 and 24 Bravo to get an income for a single period. Next, to comply with stability or trending income requirements, we must compare each period to one or more prior periods to look for stable income. The next set of calculations that have to be completed is to support secondary incomes, for example, a 1088 comparable income analysis to make sure the business is stable and growing, or liquidity testing on partnerships and corporations to make sure that the profits shown in the K1 were actually poured out and paid out to the borrower. And the last thing, and what the focus of this training is, non-math related qualification requirements or underwriting advisories. Now, these examples are basically saying borrower must have X to qualify for Y. It's not math, it's an additional requirement. Before we get to the written advisories, remember there are 4 requirements for all income. Our advisories will not repeat these 4 requirements because they are core and required for all income. So bringing them up over and over would just kind of cloud the advisories and create a bunch of redundant things that we don't need to keep publishing on each income. So for the first one is income must reasonably continue for 36 months to qualify. No agency allows an income with less than 36 months. So for example, you have child support that's going to end in 24 months, it's not usable. If a borrower is working a job and they're going to retire from it in 6 months, it is not usable income. The second requirement is income must be stable to qualify. Now we'll define stable by doing enough math and explaining that in the future slides. Income must have the required history to qualify. Now, looking at the guidelines, incomes have different history requirements to qualify. For example, you cannot qualify with self-employment unless you have 2 years and 1 year on an exception of earning that income from that particular business. But Social Security, you can qualify on it the first month you get it. The last thing is income must be documented to qualify. In today's industry, except for maybe non-QM, you have to document the income. There is no more stated income that was around back in the 2000s. So you will be asked for pay stubs or W-2s or VOEs or business tax returns to qualify. So our underwriting advisories will not reinstate these 4 rules. Now, the categories income advisories are broken down into 3 types: stability risk advisories, rule advisories, and additional income advisories. Keep in mind, IncomeXpert is not the final call on a yes or no for an income. It provides your team with the information you need to make a good decision. Let's review stability risk advisories. Now, these advisories are defined as income is most likely to continue for the foreseeable future. Remember, point number 2 on the 4 requirements for all income is stable income. What we're looking for is not the highest income or lowest income, but the income to go forward. Keep in mind, most mortgages are 15 or 30 years. So if the income is unstable, it's not likely that they'll be able to pay this mortgage for many years to come. So we have to get down to most likely to continue. Fannie, FHA, USDA, VA do not have guidelines with limits up or down. Now, there's best practices that we have learned over the 12 years in business, but there is no written up or down that we can point you to in the guidelines. Now, Freddie Mac actually outlines in 5301.1 about 2 different variations between 10 and 30% or greater or under. FHA will define self-employed income of 20% decline or more requires a manual downgrade. But outside of that, there are not a lot of written limits, maybe outside of a few USDA requirements for that. So, Blueprint IncomeXpert, on over 3.3 million loans reviewed, which is more than 8 million types of income because each loan has more than one income on average, has found the following trend. 0 to 10% typically gets no pushback on this minor amount of change, up or down. Now, we found that 10.01 to 30% is possible, and the closer you get to that 30% becomes the more not acceptable, but it requires underwriting risk review and compensating factors explained. For example, if you have a borrower that has an 18% base pay increase from prior year to current year, that is not normal for an employee to get that. Or if a business has a 27% jump in net revenue from one year to another, that also is not normal. It doesn't mean you can't use it, but now the underwriter needs to see what is going on by asking questions or look for compensating factors that would show this is not an issue for stability. Maybe another thing like low LTV or assets to show that even if this income is minor or major, but maybe not continue, that the borrower still is very well qualified to get the loan. 30% and greater in almost all cases would not be acceptable even with comp factors. Now again, these are best practices that we have learned over millions of loans reviewed in our history. Now, let's go through the examples of stability risk advisories you're going to see. Due to recent large increase in income, IncomeXpert recommends underwriting evaluate for stability. That goes with the over percentages. Once you go over 10% increase, it will advise you that on what to do. Self-employed income has decreased more than allowable company guidelines. This is the advisory you'll see when the decline is over 10%. Overtime income decline over last year exceeds company guidelines. The same as the self-employed. It just means that if you're going to use it, it's over 10%. That's why it was not automatically recommended. And more than likely, you're going to need some kind of underwriting information or additional information provided. Now, what do we recommend when you see these stability advisories? Get letter explanations from the borrower to understand the income better. Get supporting documentation to support the explanation. Now, you want to make sure you can support the explanation outside of what the borrower said and that, an unbiased third party would agree with your conclusion. Get more information. Now, what we found in our experience is sometimes you got to get a third tax year, or you got to get a letter from the employer or another outside source to show that this instability really is a non-issue and is temporary in nature. Now, when you've made your risk decision, make sure you write the explanation in Blueprint comments box for that income, and that you have supporting documents that should be sent with the end investor. Remember, we are not the end investor and not the end authority. This information given to us must be provided to your end investor. Blueprint allows approved client team members to adjust selected income. So in the advisories, sometimes our clients will say, well, we want to use something different than you've issued because we do have that 10% threshold that will not recommend income if it's going down, and we have that 10% threshold that when it's going up, that require an underwriting review. You keep in mind, you keep getting reps and warrants on all math completed, all guidelines, and all extracted data if you're using our automated income review, which is our OCR AI review uploads. Now, the final number and rationale is fully responsible from the client. If the end investor does not accept your explanation, this is not rep and warranted because you are taking on a risk that requires a lot of information that our system can't give you. Like maybe a lot of money in the bank, low LTV, long history at the job, or other things like that. This is where the underwriter is paid and trained to know how to evaluate those risks and when they're acceptable. This is not something software can do or any AI that we have that will handle. This is still a human review based on your company's risk tolerance. Rule advisories. Now, these are a little more simple. These are just the non-math rules that must be followed. They're in addition to the 4 requirements for all income. They're outside of that. They detail by investor and are used to better fine-tune rules in limited circumstances. Examples of these advisories are borrower may have to have a primary residence payment and 12 months rental history for full rental income. That's a Fannie Freddie rule that's in addition to using other rental income and has qualifiers. More than one source of current employment is being utilized. Confirm that borrower meets all secondary income guidelines or second agency guidelines. Now, this rule you're going to see when you have more than like one job or job and self-employment, because the rules in all the agencies require that they have a 2-year history of being able to handle 2 jobs at once. Or the ownership rule at the bottom, that is used on 1120s for Fannie Mae only because they don't allow business adjustments for qualifying income when the borrower is not 100%, which is unlike Freddie Mac, FHA, VA, USDA. Actions to take for these rule advisories are just make sure you check the guidelines directly for further details. Now, these are agency level only. Your investor may have overlays. Now, that is very rare. They typically leave math alone, even if they're a non-QM or not using the agency rules directly. They may reduce documentation or something, but typically not mess with the math. Document in the comment box the way you satisfy this rule. For example, borrower meets 2-year continuance of history of working 2 sources of income. Like, where did you look to figure that out? The advisories are stored with the final income worksheet. That way, everybody in the future can see the underwriter's final decision thought process. And finally, additional income advisories. Now, what these are just reminders of adjustments to get more income. Our system will remind you that there might be additional income found on certain lines. You can review if they qualify or that the tax returns are a little complicated and it needs a human being to read through it because tax advisors or preparers don't say things the same way. For example, the word amortization can be AMT, or the word amortization written out, or AMRT. It could be on one form or a supplement form. There's a lot of different areas that our software would not have the ability to read through hundreds of pages and narrow it down because the word amortization appears so many times. That's just one example. So you don't need to add this income, but if the borrower needs to qualify with a little bit of underwriting risk or review, you could add the additional income. And we'll remind you of where you can find the additional income to possibly increase it. Now, examples of this on the liquidity test, we'll tell you that Schedule L, line 3D inventories may be able to use if they're not required to supply the business. There's a lot of rules around that. Rental income. Look at line 19 to see if they've written off the amortization, casualty loss, or HOA dues if the borrower has HOA dues on their PITI. Or on the Schedule C, client must review line 27A for amortization, casualty loss, or one-time expenses. You might be able to add back income if you find it on that line 27A is referring to an addendum on the second page of a Schedule C that may find those casualty losses or amortization. Any questions or any support, we provide all customer support by contacting us first by email. It's the best way. We will respond within 2 business hours during our normal operating hours, and those hours are 8 a.m. to 6 p.m. Eastern Standard Time. info@getblueprint.io is how you contact us. We will respond by email, possibly create you a video response, or make a phone call depending on what level of support is needed. But the best way to start the support request is by email. Please reference our file ID, not your loan number. That will give us time to look at your question in the email and look through the loan and formulate an answer. I hope this presentation has been helpful. Thanks for using IncomeXpert. We appreciate your business.